And I think that's so important to understand because it really does drive the reasoning behind why we see charts like this. And then also that same pattern. All right, this again is the pre-roaring 20s move. And here's your roaring 20s into, by the way, if we zoom out here or go out, look at the economic collapse. And then if we flip back to the S&P 500, look at that same up-down move and look at the move. And guess what? If we go back here, we have just started the decline, in my opinion. All right, so again, this is eerie, but what it potentially speaks to is some very big downside in the market over the next, 10 years or so.
Popular technical analyst Gareth Soloway is famous for his contrarian views on the markets. Whether it is for Bitcoin, the stock markets, or commodities, Soloway always manages to give a different perspective that many other analysts refuse to consider. He was one of the first people to warn that Bitcoin would hit $20,000 or even lower in 2022. What's even more surprising is that he made this call late last year when many other analysts were predicting a new all-time high for the world's largest cryptocurrency. Since then, he has continued to make appropriate tweaks to his price predictions for the leading crypto asset and other asset classes. In a recent broadcast, Soloway discusses his outlook on the macro environment and the S&P 500 in 2023 and beyond. Though he expects one more rally before the year ends, the renowned technical analyst is convinced that 2023 is going to usher in some unpleasant surprises. Here is a recent tweet from the veteran trader. The more the market sells into next week's Federal Reserve meeting plus CPI data, the more I favor an end-of-year rally. 2023 will be a very ugly year, though. In a follow-up tweet, Soloway notes that he believes the popular U.S. stock index will fall below $3,000 in 2023. If the Federal Reserve is expected to soften its aggressive interest rate hikes and quantitative tightening in 2023, why does Soloway expect the year to be ugly? The veteran trader answers this question in detail in his broadcast, where he draws some scary similarities between the Great Depression and today's price action. We will now take you to Gareth Soloway's broadcast. But before we do, please take a little time to support our channel's growth by hitting the like and subscribe buttons and turning on post notifications for more videos like this. We also love to hear from our viewers and subscribers, so ensure you drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and contributes immensely to the channel's growth. Thanks and enjoy the video.
I want to discuss the similarities between what happened in the 1920s into the Great Depression and what we've seen in the stock market. I want to look at similarities, interesting little confluences inside the charts, as well as other things. And it's really mind-boggling and amazing to me. And this is something I hope everyone looks into, is looking back in history. You can learn so much about the future by looking at history. And the reason that is because generally people always are the same. Greed and fear, emotion drives the market. Doesn't matter if it's in the 1920s, doesn't matter if it's in the 2000s. Heck, it doesn't matter if you look back at the tulip mania, I think it was in the 1500s. It's the same. Human nature doesn't change. So things that occurred 100, 500 years ago, 1,000 years ago will repeat again. So what we're going to do here is we're going to take a quick look at the charts and go over the chart of the S&P. So what you see here very, very clearly, look at this, right? So we have this up move, which was the late 90s. This was the dot-com move up, and then this was the dot-com collapse in the S&P 500. Then we had the move up into the 2017 high. You can see a pretty crystal clear double top there, and then the collapse. Now, what we know is that there was massive stimulus that came in this period here, and we saw the market move to the upside here. So again, this is the recent run. I'm not showing the recent small pullback in the S&P off of this run for obvious sake. You'll understand in just a second. But look at this move to the upside here, folks, that ultimately took place. Now, the next thing I want to do is I'm going to flip over to the Dow chart. And you might say, well, why the Dow and the S&P? Well, the S&P is the common index of today, right? So if you go back to the 1900s, early 1900s, you actually have the Dow. That was the main index back then. So you have to compare apples to apples in that respect. All right. So what I want to do now is let's take a look at this, right? And what you can see here is look at the similarities in what happened here. Okay. All right, so this was, again, starting in 1915, and then the pullback, and then the up move, and then the pullback, and then look at the run the market went on. Eerily similar on the Dow Jones Industrial Average to what we have seen today. Now let's talk about some of the similarities in factors that have gone on here, right? So basically in the early 1920s or so, coming into that period, what did we have going on that helped this boom? Number one, the introduction of electricity. Now, interestingly enough, what we saw in kind of that 1915, 1920 period, when you were seeing that kind of up move, down move, up move, down move, the introduction of electricity, and obviously cars became much more available to people as well. Now, interestingly enough, in the late 90s, early 2000s, what did we see? We saw the introduction of the internet. And what we saw is how the introduction of electricity, it increased the opportunities for people to go out and about, to go to shops after dark. It was okay. You could drive to further places. It increased consumer spending. And in the 20s, all right, the 1920s, one of the biggest things, it was called the Roaring 20s. It was people getting out, the consumer getting out and shopping. All right, it was spending money. It was a consumer, it was the beginning of the consumer-led economy. Now, what's fascinating is that what happened in the late 90s to 2000s and all the way up to where we are now. And the answer is that we started to get consumer spending to go to the next level. Now, you might say, well, why? Well, number one, we know the Fed was stimulating, right? So it was stimulation there, but also the internet opened up a whole new world of shopping. Amazon, Google, all of these places where you didn't have to even go out of your house now. You could just go online and spend money. Much different than pre-1995 or so. And really in 95, let's be fair, the internet, I think, was in a total of like 10% of households. Really by the early 2000s, it started to permeate in most households in the US and around, well, not around the globe yet, obviously, but more and more around the globe. So you see how the similarities, how you have this technology that's introduced, that's game changing in both the early kind of the mid 1910, 1915, 1920s with the car, with electricity, and then here with the internet, going into this recent period that stimulated consumer spending more and more.
Soloway explains further that the same massive rally the market saw during the years leading to the Great Depression has now been entirely replicated in the S&P. The scare from the 2008 financial crisis led to some of the biggest rounds of quantitative easing the global economy has ever seen. Between November 2008 and September 2012, the U.S. Federal announced 3 rounds of quantitative easing programs injecting trillions of dollars into the economy. The third round of quantitative easing earned the popular nickname QE Infinity because of its open-ended nature, but it finally ended in October 2014. Then COVID came and the Federal Reserve announced another QE round, adding another $2 trillion in assets to its balance sheet. These various rounds of quantitative easing will not go unpunished, and according to Gareth Soloway, the stock markets might be in for a decade of massive price declines. Here is the rest of the broadcast.
And I think that's so important to understand because it really does drive the reasoning behind why we see charts like this. And then also that same pattern. All right, this again is the pre-Roaring 20s move. And here's your Roaring 20s into, by the way, if we zoom out here or go out, look at the economic collapse. And then if we flip back to the S&P 500, look at that same up-down move and look at the move. And guess what? If we go back here, we have just started the decline, in my opinion. All right. So again, this is eerie, but what it potentially speaks to is some very big downside in the market over the next, 10 years or so in reality. And again, it would not shock me, and I'm going to throw this out there. I'm not going to make this as an official call, but in a worst case scenario, you know where we could go? We could go all the way back and retest the scene of the crime on the S&P 500 at around 1,600. And that, to me, my friends, is something that we all have to be aware of. We have to be cognizant of, because how do we protect ourselves? Yes, we can go short. Yes, we can go long, but I'll tell you, swing trading is of the utmost importance. Learning how to be disciplined is of the utmost importance. And also learning human psychology, understand why markets work. I'll tell you, this period, if you look at the market all the way up to basically 2021, it was a long-term investors market, right? The Fed was involved from 2009, the lows there. It was a long-term investors. You just bought and hold. You bought every pullback. It's different now. Swing traders are going to emerge as the ones that are going to make the most amount of money over the next 5 to 10 years. I've gone on record before saying I don't think the S&P makes a new all-time high, probably for at least 10 years, maybe 15 years out. A lot of doubters out there about that call. That's what they said about when Bitcoin was at 69,000 and I said it was going to 20,000. That's what they said when oil was at $130 a barrel earlier in 2022 and I said it was going down sharply. Here we are. We know the results. The reason why I'm good at these calls is because I study history and human psychology, and it changes the game.
Unlike Gareth Soloway, Real Vision Chief Executive Officer and popular macro guru Raoul Pal believes things might play out differently in 2023. In the recent edition of the Global Macro Investor newsletter, Pal says global liquidity is about to pick up, which would bode very well for asset prices. Here are some statements from the newsletter. We're on the precipice of a major turning point. The bear will soon go into hiding, and the bulls will return to resume the uptrend they left behind not so long ago. As World War II came to an end in 1945, the world found itself in a very similar situation to that of today. High debt, negative real rates, fiscally driven capital allocation, and rapid technological advancements were all present back then, just like they are today. That's why my base case for the coming decade remains the period from 1945 to 1965. Back then, equities rocketed with the announcement of war, same as the pandemic, and the economy subsequently fell into recession shortly after the end of the war, with the market correcting around 20%. Keep in mind that this was a generational low that became the jumping-off point for a 5x increase in the following 2 decades. My thoughts are that the coming change to the bond market, the easing of bank balance sheet constraints, the Fed pause, as well as the fiscal stimulus all come together to generate a reversal in M2 growth. US M2 year-over-year is right back where it was in 2018 when they last reversed course on rates in QE. Once the ISM crosses 50, liquidity comes in to try to buffer it. It's possible that changes in bank regulations or Operation Twist will kick off the liquidity boom. In the newsletter, Powell points out that China is already recording massive growth in credit and M2 money supply. According to Raoul Pal, this and the change in ISM suggest that the bottom of the business cycle is coming in Q1 2023. Unlike Gareth Soloway, Pal expects the S&P 500 to begin to show signs of recovery from this year's lows as soon as the liquidity cycle changes in 2023. And the same applies to Bitcoin, which has so far been highly correlated to changes in global M2. What do you think about Gareth Soloway's and Raoul Pal's assessment of the macro environment in 2023 and beyond? Are we going into an ugly year, as Soloway predicts, or will a change in the liquidity cycle bring a much-needed relief rally for assets? Let us know what you think by dropping your comments and observations in the comments section below. Also, ensure you like this video and share it with others. For more videos like this, please subscribe to the channel and turn on post notifications if you are yet to do so. Thanks for watching.